Welcome to the Sojourn Wealth Management Podcast. My name is Jeff Bronner, and I'm joined by Andrew Kraft and Corey Akins. Today, we're going to be talking through another episode of our series on investment basics. How are you guys doing today?
Doing great. Good morning.
I'm doing well. Good morning.
Wonderful. So today's episode, we're going to be covering something similar to what we've talked about in other podcasts, namely, for the listener, episode 13 in fixed income, episode 14 in equities, and episode 23, our last release episode, asset allocation. And we wanted to dive a little deeper into specific investment philosophies, the ways that people essentially invest. So with that, let's start with the most volatile. What's the most volatile way somebody could invest? I suppose there are a lot of volatile ways, but generally speaking.
Most volatile. So survey says day trading?
Day trading.
Ding, ding, ding.
Unless there's like minute markets out there or something like that where it's shorter increment of time.
Yeah. So I'll just unpack that a little bit in case, that's what, people will invest trying to just find short-term market movements, buy and then sell within moments or hours or microseconds if they got some, Hydra supercomputer or whatever. But it's funny though. I think for some day traders, they actually have maybe claim a little bit of a conservative risk management by exiting all their positions at the end of the day. So they, nothing going to happen over in the overnight markets or something like that. But yeah, that's pretty volatile, pretty speculative.
And pretty technical too, right? So a lot of day traders are.
Yeah, absolutely. Good point.
Are looking at technical movements in the market and trends and things like that.
Like the company name doesn't matter, it's just what it's doing kind of thing?
Yeah,
right.
That's right. And so they'll look at, okay, where's the market headed? And, there are things that you can glean from that. And then, higher highs and lower lows. And they're looking at a lot of that stuff. So very speculative, very much in the business of trying to make a profit, obviously, day after day. So I would say that's probably, and most people probably in the general public know that too, right? Like they they probably have seen day traders, or at least their buddy who's showing them their phone and trying to day trade a little bit. So yeah.
And when
I was just going to say those charts, I think that's where like the terms like resistance and support, which is not just, in the day trading, vernacular, but common, business news kind of mentions that as well. And, if it breaks a resistance level, then it's time to buy. Or if it breaks a support level, it's time to sell. And, is it? I don't know.
Yeah. That's the speculative component of it is we don't know.
And by the time we hear about it, it's pretty much too late, right? I mean, because the movements in the market have already happened and they're already, again, day trading and kind of in real time.
Yeah, there's a whole episode we could do on efficient market hypotheses and all those things. But to avoid that rabbit trail, I did want to unpack just that technical approach you were talking about, Corey. It's like when you're looking at the chart and you think you know where the next movement's going to be, where's the line going to go next? And that's really hard to do consistently.
And a lot of times
above its 20-day average or whatever.
Yeah, and a lot of time it can just be, sometimes it can be based on buyer sentiment or seller sentiment and kind of where people are and what they see, either pullbacks or, hey, we're going to buy a lot, and day traders make decisions based on things like that too, right? So
one up from that scale of just kind of intraday trading is momentum investing. Corey, do you mind unpacking, what momentum investing is and how that is a step away from day trading, but still kind of in that direction?
Well, basically seeing what the hot investment is, or seeing something in the upswing, and then you're trying to track that, right? And you're trying to go and buy that stock or that fund that has momentum and essentially chase it. And so I think that happens a lot. I think a lot of the general public will see a stock or a company that is perceived as profitable, valuable, and then they go and they buy it based on what they see. And so that would be kind of the general definition.
I think you can extrapolate that also out just to an asset class. Like people might say, hey, domestic stocks are doing well and they've been on the upswing, and so we're going to tilt a part of our portfolio more toward that and kind of ride that wave, so to speak.
Yeah.
Kind of leaning into, I was thinking sector, even like
Yeah.
technology with the AI boom and all of that. People have been really interested in that. Some people have been wary of it, but a lot of people want to lean more into that. And that's kind of that momentum investing philosophy. So moving into a more, less volatile, moving in that direction, what would be another way that somebody could take their funds and invest to seek growth without necessarily seeking speculation?
Like an individual investor, maybe is where you're going. Like dollar cost averaging, I think is a strategy that is very sound and has, a lot of just straight math history, behind it. And that's the idea where instead of just putting a whole, big chunk of money into the market and whether you're going to speculate or not, the alternative is you just put money in every month, or what a lot of folks do just with their retirement plans, you put money in every paycheck.
Yeah.
And the idea there is that with the same dollar amount going in every time, as the market goes up and down, you're automatically a bargain shopper because that same dollar amount buys more units or more shares of the investment as the market goes down because they're on sale, so to speak. And then you're, a wise, prudent buyer, not buying as much when the market goes up. And so over time, the average value per share is actually greater than the average cost that you've paid per share.
Yeah. I was going to bring that point up, but
did I use the right terms?
I think so. Yeah. 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 Essentially, you're getting the best bang for your buck with dollar cost averaging.
Yeah.
So,
and it's amazing because the market can, like, for example, a quarterly statement. So most investors get quarterly statements, sometimes monthly, but let's just think quarterly. The market can be the same at the beginning and the end of the quarter, but during that time period, it could have dipped and come back up. But because you're dollar cost averaging, you actually have more in there because you bought more units on the way down.
Right.
Even though the value is different, the value of your account is more than what you paid for it. And sometimes it's helpful psychologically, I guess, because the market's going down. You're like, well, why am I buying into this? Well, same kind of thing. For those older listeners, there's like the blue light special at Kmart, where things are on sale.
What's Kmart?
And you buy more of it. So.
But you bring up a good point. I wanted to mention the disciplined nature. The disciplined nature of dollar cost averaging is regardless of what, trends or, emotional experiences happening with the market, you're still committing yourself to that same rhythm of investment. And so we're not really talking in the behavioral psychology side of things, which is kind of what you were hinting on earlier, Corey, with just the different hypes and excitements and things of that nature and how markets can be unpredictable because of that. This is kind of the inverse of that, where through just a disciplined investment strategy, you can, through the math, like you mentioned, there's a lot of really cool illustrations of how dollar cost averaging works over time to increase your value of your portfolio.
Yeah, and one real quick, I'll mention, one of the biggest, market issues, if you kind of go back past, the Great Recession and the tech boom, just kind of go all the way back to the Great Depression. People lost a lot of money, year after year after year. And so I was kind of just doing some, quick math. And if you invested and at the beginning, it took you 6-7 years to just get back to even. But if you had kept on with that discipline, Jeff, like you were talking about, then you're back after only a few years. And so it really is important to kind of have that discipline when the market's going down. If your perspective and horizon is long term. Otherwise, you shouldn't be investing, right?
Right. And so that's a good kind of overview of what is a good philosophy or a good strategy, a good how. What would be different types of investments that somebody could dollar cost average into if they were wanting to participate in the S&P 500, say?
Yeah. So that's the name of a common index. And so I think this phrase indexing is another investment strategy where the idea is I just want to have low cost because that's a drag on my investment that I can control, right,
Mhm.
by just kind of keeping the cost down. And I don't know what sector or what company or whatever is going to do better, or even, geographically. So I'm just going to try and invest in the entire stock market. And then that's broken up into different things. But, sometimes there might be a portfolio that has a bunch of U.S. big companies and then some international companies or some bonds or whatever, but it's just an index. And so those index funds or strategy indexing, I think, is a really common and popular one as well.
Yeah. And very passive strategy too, right?
Yeah.
As far as just the holdings. So, very, very common.
And there can be a portfolio that's comprised entirely of index funds,
Mhm.
right? And then from there, there's all sorts of different ways you can build out a portfolio. And again, this goes back to our asset allocation episode. But what would be a way that you could build on an index portfolio?
Yeah. So I think one turn of phrase is base and build, where you kind of acknowledge, hey, that index fund is a great foundation, but then let's try and build out from that and get some satellite exposure to, like you mentioned, the AI kind of technology area or some other sector that you really believe in, and you don't put a lot on that, but you just kind of build off of the base of the overall index.
I think that's referred to as like a satellite kind
Yeah.
of position, right? Like you have your main portion of the portfolio, and then you have this little 2% out here,
Right.
touching this other opportunity. That's a good kind of overview of what it looks like to invest. What if somebody's wanting to receive money? They're not investing into the market anymore. How can they invest in order to start getting that money back if they're expecting income in a short time period?
Well, the main way is dividend investing. So income focused. And when I say dividend investing, mainly just a company is profitable and then they send some of that profit back to their investors. And so the easy kind of example is a company who has a stock that's, worth $100 and they pay you out $4 a year. So that yield on the stock is
4%.
4%. That's right. That's easy math, huh? So essentially people will fix portfolios with that specific goal in mind. And essentially the idea is to create income, right?
Mm-hmm.
And monthly income typically. And so it's not so much that you're concerned about the value of the account, like you are, obviously, but the main piece of the account that you're worried about is the shares that you own within it that are producing dividend or income. And so a lot of folks will consolidate accounts to do that. And then they have an income stream that is pretty consistent. Now, again, dividends are never guaranteed. Like you're never guaranteed to be paid out profits from a company. And a company is never guaranteed to be profitable. But you can look at funds and positions that are pretty consistent and have been pretty consistent for a long, long time and say, okay, we can generally assume that there's going to be about a 4 to 5% yield that comes in. And a lot of people build retirement plans doing that. And typically they're income focused, so they're going to be more conservative. So that's in a nutshell how it happens. But yeah, lots of ways to unpack that and lots of ways when you talk about taxes to unpack that as well, right? So, yeah.
And Jeff, you mentioned some of the previous episodes, and I think we touched on this with diversification, but, Corey, you were saying a company paying you profit. Well, just to kind of guard against that risk of the company not being profitable, that's where you have a bunch of different stocks or a fund that holds a lot of different, stocks. And I think another good benefit of that is how they address inflation, because generally the stock will increase that dividend to kind of keep pace or outpace, inflation. And then of course there's also bonds, which mainly we're talking about stocks here, but bonds or fixed income kind of has that in the name. They're going to pay interest, kind of similar.
And in things like a mutual fund too, right? Like you're going to get both. So it's not necessarily going to be one or the other. And a lot of people like the mutual fund idea because you do get both. So that's a great point.
There is so much that we can unpack further. I know that we're just kind of skating across the surface here to just introduce these topics. But for our listeners, if you found value in this conversation, you want to know more about these ideas and these different investment strategies, we would be glad to sit down with you and provide further education. Give us a shout, give us a call, and we'll schedule a meeting to talk about it.
Thanks.
Thank you for listening to this episode of the Sojourn Wealth Management Podcast. This is a friendly reminder that all content in this podcast is intended for educational purposes alone. Nothing in this episode should be treated as tax, legal, or investment advice. We encourage you to consult your financial professional for any of those needs. Securities offered through Kestra Investment Services, LLC, Kestra IS, member FINRA SIPC. Investment advisory services offered through Kestra Advisory Services, LLC, Kestra AS, an affiliate of Kestra IS. Kestra IS or Kestra AS are not affiliated with Sojourn Wealth Management.